Again, my first question I would like to ask all four of you, and please give as close to a yes or no answer as you can. The world is troubled by the extent of the fraud and misconduct at FTX. We all agree on that. Too many people have lost money they thought was safe. Some have suggested that what we see at FTX was unique, a one-off caused by one immoral fraudster rather than something more widespread and systemic. So starting with you, Professor Allen, does this kind of carelessness, misconduct, or worse exist at other crypto firms?
Yes.
Mr. O'Leary?
Yes, the unregulated crypto firms.
Ms. Schultz?
Most likely. Most likely.
Ms. Schenken?
It's endemic.
Okay, thank you. Professor Allen, we know that FTX was over-leveraged, but look beyond, as you did in your testimony, beyond FTX. Given that a lot of crypto trading recycles one token into another, often with borrowed money, it seems as if the value of crypto has detached itself from the actual currency that was originally invested. Is it possible to determine how much leverage there is in the crypto market? And if it isn't, why is that a problem?
Well, I don't think it's possible to determine. I think researchers have really struggled to find data in this space, notwithstanding that people say that the blockchain is sort of transparent. In fact, a lot of transactions happen off-chain. There are a lot of sort of backdoors in software. So the data is not available to figure out what transactions have happened. And the accounting around the individual crypto assets themselves can be very dodgy as well. So, even before you lose track of them in transactions, it's not clear what they were worth up front. So for all of those reasons, it's very hard to get a bead on what the leverage is in this space, and that's problematic because, as we saw in 2008, when you don't understand how much leverage is in the system, you don't understand how fragile it is.
Thank you. Mr. Schenken, your testimony highlights the similarities between crypto and gambling. Based on your research, can you describe the parallels between gambling and stablecoins as casino chips?
Sure. Economically speaking, these are zero-sum games, strictly competitive. For someone to win, someone else has to lose. That does not mean the distribution is even. We know at this point most people who have invested in cryptocurrency have lost money. We know that from the industry's own research. Grayscale December 2021 report said that 55% of people who have ever bought Bitcoin bought it that year. Given the current price of Bitcoin, those people have lost money. That does not include the people who have been locked out of their accounts. The list is very long. I included in my written testimony. So this is gambling. This is speculation. At best, zero sum. That's not including the environmental costs that Bitcoin incurs. There are also members of the industry who come from online poker. I would refer you to Stuart Hoegner, general counsel of a company, Tether, stablecoin company. He was former compliance officer of Escapsa, which was the holding company of Ultimate Bet. Ultimate Bet, from the online poker era, had a secret God mode where players could could see the other players' cards in order to defraud them, in order to win at poker. Stuart Hoegner was joined at Escapsa by Daniel Friedberg. Daniel Friedberg was the former general counsel of FTX. He is now their chief regulatory officer. Alameda, FTX's sister company, is Tether's biggest client.
Thank you. Last question, again, if you would answer as close to yes or no as you can. I want to talk about solutions. FTX, like other crypto firms, perform multiple roles in crypto trade. It acted as an exchange, and as a broker, it provided margin to investors. FTX was essentially on every side of every transaction. Combining these functions undermines the fundamental regulatory checks and balances that exist to protect consumers and to protect our financial system. Should there be, my question, starting again with you, Professor Allen, should there be strong rules addressing related party transactions and creating firewalls between related entities?
Absolutely, to address conflict of interest.
Thank you. Mr. O'Leary?
I find the analogy of crypto to be that of gambling and speculation interesting. That was exactly what we described the New York Stock Exchange 150 years ago. And what happened was, because of the nature of the risk, we regulated it. We did it for bonds. We called them securities now. Back then, they were speculations, no different than this nascent industry. The reason this is happening over and over again, and we'll be back here again soon when the next one blows up, is the lack of regulation. That's why we regulate stocks and bonds. They are speculations too. You speculate the profits of the companies underlying those securities. We need to regulate this. I mean, this premise that it's some kind of different issue, it's not. It's just unregulated Wild West, and it will go on and on and on. It's the definition of madness is expecting a different outcome. I mean, that's just, it needs regulation. That's it.
I take it that's a yes, that there should be strong rules addressing related party transactions and creating firewalls.
A long yes.
Okay, a long yes. Ms. Schultz?
I also have a longer answer, but I'll still keep it short. I do think that conflicts of interest are something that need to be examined and addressed, whether that results in strong rules banning certain types of transactions or whether it is simply that disclosures must be made is a different question. So while I agree that there are potential issues there, I'm not sure I will agree with the outcome that you're looking for, Mr. Brown.
Thank you. Mr. Schenken?
Yes.
Thank you. Senator Toomey.